before we go to a new section of the Chameleon, I'm just going to share the disclaimer one more time. All right, take it over, D.
Okay. So let's review these single leg option trades. And I'm going to close this menu over here.
Can we
And
use Tesla as an example? Not that it really matters, but I'm just wondering, just because they had their big announcement last night, I'd be interested.
okay, so I'm on Tesla now. I'm going to close this menu. I'm under a single leg dashboard. And what this is looking at is uh, the single leg option trades, we're reviewing, and um, it's isolating those single leg trades and then performing an analysis from different perspectives. So it's looking at, you know, uh, the calls, the puts, and those that are not involved in like a multi-leg or contingent trade on the trade team. And then it's performing these analysis to get different insights. And we talked about, some of the uh, different metrics that we use to analyze it to get some insights. We talked about, the top part up here, notable trades. I think we did the traded volume by deltas yesterday, so we stopped there. So let's just continue from there. All right. And when we look at the trades, another question that can pop up is, well, what type of traders are using the options, and what is the distribution of these traders? Because you could have uh, participation by lots of retail traders or mostly retail traders. You could have participation by very large traders or institutional traders. Then, you have also traders that are proprietary traders that maybe fall somewhere in between, that trade larger size, but aren't necessarily like this big institutional trade. And who's participating in it? What's that makeup look like, the volume? It's a question people want to know, where the trade's coming from and how much participation. Now, when the issue then you have is, well, every time when we have a trade, that information is not on the trade team, right? Like when you enter in a trade and it gets executed, the exchange doesn't tell us, well, this is a retail trader on this trade. This is an institutional trader. So it doesn't tell us that on each on the time and sales. Okay, so that's not on the trade tape. Well, because it's not on a trade tape, then we have to kind of make inferences, right? So we have to infer from a trade what's this trade most likely? Is it coming from a retail trader, or it's an institutional, and can we make that inference? So for example, we see a trade that's one contract, for whatever, a couple $100, and we don't see any other trades right before, immediately after it, that we could connect it to, well, that's more likely a retail size trade, right? Because, might be an institution, but it's, for an institution, they usually look for a bigger size trade. Then if you have a trade that's like maybe 1,000 contracts or 500 contracts with a notional value of a couple 100,000 or 1 million, well, that trade is not typical of a retail trader, right? That's more of an institutional size trade. Maybe there's a retail trader out there that can do that, but it's not typical. So we're making inferences here of what type of trader is accessing this. And especially even if you have a very big retail trader, to enter in a trade that size, you need approval, right? Even if you have the money, you would need approval because there is certain regulations on order entry that would require you to get approval, and there's a there's this regulation, pre-order that they have on every order that you have to go through to make sure that you're approved to enter in this type of sizable trade. So given that context, we could break it down based on over here, the the trade itself. What does it look like? Is it, does it look like a small retail trader? Does it look like maybe a retail trader, not so small, but not big enough to say, that this is definitely, a professional, proficient trader that needs more approval. And then you got this large trader where, it's a sizable trade that you don't typically see in an options market. So this is the breakdown. Okay, that we look through those trades, like for example, here's some notable trades. You got 3,000 contracts that we interpreted sold for $1.08. Well, that doesn't look like a typical, it's not a small trader. It's not a typical retail trader. That probably will fit into a large trader category. Actually, all these, that I'm looking at would fit into a large trader category. So this is the breakdown that we saw in Tesla. And, you got 28% look like small traders, small retail traders. Then you got another 30% that also look like retail trading, but not very small, more than $1,000 in notional and 10 contracts, so sometimes you get these one contracts or less than, I think it's $2,000 worth in notional. So I think a small trader, they let you start out less than 10 contracts. I think, well, I have to look again, but typically it's up to your broker, but they'll cut you off based on, number of contracts and notional value. Then you got the a little bit more experienced retail traders, that's 30%. Then you got maybe more active professional traders, proficient, 25%. And then the large trader was 18% of the volume. So there's a decent distribution there. And it's not surprising in Tesla, we got, everybody participating. It's an active stock, right? It's a well-known, and you have participation from all types of traders, from small retail to very large. And you could see that even if we split it up into two, you got 28 and 30. So you got 58%, a little bit even more than 50%, 58% of the trading volume looks like it's coming from, small retail size trades. So now you get like this idea of who's participating, and like what's the, I guess, proportionality or magnitude of the participants. Okay. So that's what this quickly visually, as we scan, tries to answer. Then we have this breakdown, volume by exchange. And when we look at options trades, we're in a very fragmented marketplace where we have lots of exchanges that compete for order flow and that you can execute trades on, place orders on, and they're all connected through this Reg NMS system. Okay, so what we do is we have like this concept of NBBO, National Best Bid and Offer, which consolidates all the displayed quotes on all the exchanges, the BBO, and creates this national best bid and offer. So when we look at a quote and bid and offer, that's made up of, you know, all these fragmented markets uh, and different exchanges that trade these options that are made up of market makers, lead market makers, specialists, limit order books, and so forth. It's all consolidated, and we get this best national best bid and all. Okay. Now, this shows the trade volume. So the trade volume that we're looking at here in the single leg trades. And it gives us an idea of the percentage of the total volume traded by this exchange. So we can see PHLX, the Philadelphia Stock Exchange, which I think is owned by NASDAQ, traded 12% of this volume that we're looking at, the single leg trades, 12%, which represented the biggest portion of all the exchanges. Then we have the ARCA 11%, NASDAQ 9%, and so forth. Now, so we got it all the way going down, right? So why is this important? Why do we want to know where the volume is traded? Well, if you have a fragmented marketplace, you know, we have all these different exchanges. One of the things as a trader, you as a trader want to know is, you know, how can I get the best execution? Like, where can I get price improvements? Where can I get a better execution? Where do I stand a better chance, right, of getting the fill right away at a better price? Like, wouldn't you want to know that as a trader? Or, you know, you could get it routed somewhere else, but then you may not, you know, your chances of an execution might be lower because there's not as much trading going on that exchange, right? You might sit there and be the last one in line. Like, think of it as, do you want to be the first one in line or the last one in line? Do you want to, you know, get a better or wait? So all this comes into play, you know, when you're looking at your trading system, right? What does your trading system consist of? Well, you know, you got your research, you got your risk management tools, but you also have your execution tools, right? So part of your execution tools is to get a better price or be the first one to because if you're the last one, then you might be always the one getting run over. So that's why even a quick assessment, well, is there a particular exchange that sees more of the order flow or the trading? That may help you, especially if you're trying to, you know, direct an order somewhere to get a quicker execution or potentially a price improvement. Because remember, we talked about, you know, price improvements. 25% of Tesla's trades involved a price improvement. You know, a price improvement auction, meaning that they potentially got a better price than you entered in. You know, imagine like, hey, I'm willing to pay $1.10, and you know, but you bought it for $1.05. Well, percentage-wise, that's a pretty good savings, all right? Figure it out. Like, how long would it take you to earn that in interest if you had it in a bank? So that's another quick analytic to look at. All right, so let's come down here and look at this next module. So when we look at the trading, right, we looked at the volume, you know, we looked at all these different analytics. Well, what's another question as a trader you would want to know is, well, how is this trading volume distributed amongst different expirations? Where are people using options and trading these options? Is it, distributed equally amongst all the available expirations? Is it concentrated on one specific expiration, or a, certain expirations that are, clustered together? Where's that volume, that trading volume? So I know how other people are using it, where the trades are occurring, where there's, more liquidity, better chances of getting executions. So the first part of this chart shows these bars, right? And these bars are by option expiration that are available. So the top bar, the biggest bar here, and you can see it's stacked. The yellow shows the call volume. The blue shows the put volume. So this top one, that bar shows that the most traded expiration by volume is October 11th, right? Which happens, that's expiring today. So the very, very short-term option. The next one falls to October 18th, and you can see they drop off significantly, where there's a huge interest in trading these very short-term options. That's what it looks like in Tesla, right? And we could see also just by, calls and puts, maybe this a little bit more calls than puts, just visually, we could hover over it to see the amount. But this shows us a couple things, the expiration and the distribution of calls versus puts. Okay, so that's graphically, visually, really quickly, we could assess. Okay, so most of the trading is in that front month or near-term options. The next question you may have is, okay, how is the trading impacting option premiums, right? Like if you saw a lot of trading in Tesla, let's say, well, how's it impacting the stock? Well, yesterday the stock was down 1%, right? We need a reference from previous close to now. We have this volume, but how's the volume impacting value, the value or the price of the stock? Well, the same thing with an option. Well, how is the volume impacting the option values, right? But we know options are derivatives, right? What that means is that the option price will move along with the stock price. If you have a call option, which has a positive delta with the stock, right, correlates. So the call prices are, moving up with stock prices, moving down with stock prices, puts are the opposite. So the value of the options really, how do we track it? How do we measure it? Well, we measure it by implied volatility. It's premium. The implied volatility is moving up, then the option values on a relative basis are moving up. If the implied volatility is moving down, then on a relative basis, the option values are moving down. So that's the next thing on this graph that we're showing. And you can't see, but there are two lines here with either a green or red dot. And the one line is the previous day's closing implied volatility for each of these expirations. Okay. And then the next line is comparing what is the implied volatility currently on that same strike. Okay, so it's comparing like what strike right now is at the money. And then it's comparing, okay, this is the implied volatility of that strike. what was that same option implied volatility the day before? And then we could compare these two lines, and the green dot means that the new line is higher than the previous day. And if it's a red dot, it means that the new line is lower. So right now, visually, we can see a couple things here. First of all, that the term structure, the implied volatility, right, is higher in the near term options and starts going lower as you go out in time. That suggests that there's some, more risk right now in the short term, because usually you see it the other way. So when it's inverted this way, it's saying that in the short term, we're expecting more volatility than usual, right? More than you going all the way out here. It's more than usual. You usually see this, like, around earnings. This is typical because the expectations are, well, there's going to be earnings. Nobody knows what it is. There could be a lot of movement. So that's what we're seeing right now in Tesla. And we see that for the most part, it looks like almost entirely along the curve, that the implied volatility went up, certainly in the front month, and maybe slightly went up mostly. We see a couple of reds there, but not significant on the longer end. And you could see there's not even that much trading on the lower end. It just probably got lifted a little bit because of this, the shorter term options. So that's what this graph is visually letting us know really quickly. Right? We got trading volume, the distribution of trading volume, and how the options were impacted, all on one graph. So we're right up at like 9:30. I'm going to stop there, and then we'll move on after Monday to the next section. And I think you're on mute, Will.
Ooh, sorry about that. I had a little bit of a sneezing attack. Sorry about that. Thanks for all the information on the Tesla options, Dee. That was a great presentation. Thank you so much. Thank you for coming to the show, Chameleons. Everyone have a great Friday and a great weekend. Thanks again, Dee.
Yep. Thanks, everyone. Stay safe out there. Have a great weekend and a great trading day. Hope to see you guys on Monday.
Trade in peace, everyone. We'll see you Monday. Have a great